Good evening. My name is Adu-poku, a student of procurement and supply chain management level 400 student. I'm a member of Group 2, and our analysis was done on inflation and interest rate shocks in the banking industry. The banking industry is influenced by external economic conditions, especially inflation and interest rates changes. This study focuses on how these factors affect Ghana's banking sector, using the GCB as a case example. Inflation and interest rate shocks. Strategic implications for Ghana Commercial Bank. Inflation explained. Inflation is the increase in the general price level of goods and services, which reduce the people's purchasing power. It is mainly caused by demand pull, that is high demand, and cost push, that is rising production costs. Interest rates. Interest rates represent the cost of borrowing money or the return on savings. They are controlled by the central bank and are used as a tool to regulate inflation and economic activities. Now, in the Ghana context, high inflation due to currency depreciation and global shocks. Bank of Ghana increases interest rates. So what this slide is telling us is Ghana has experienced high inflation due to factors like currency depreciation and global economic shocks. In response to that, the Bank of Ghana raises interest rates to stabilize the economy. Now, there are some key trends there. It reduces purchasing power, high borrowing costs, increased financial uncertainty. There are some effects that the banking industry face when these shocks come in place or these shocks takes effect. Now we have higher operational costs, increased loan defaults, and reduced profitability. That is the short-term effects. And we have the long-term, that is need for diversification, digital transformation, and also improve risk management. So we have the industry impacts. The impacts the industry faces, or the impact inflation and interest rates shocks have on the industry. Increased competition, high cost, changing customer behavior, great risk and exposure. So if a bank is not able to run smoothly, its competitors takes an advantage over them or has an advantage over them, because if they are making losses and then the interest rates are high, customers will opt for uh, a bank with lower interest rates. That is, it will change the customer's behavior and it exposes them to great risks. Now, the overview of the GCB Bank. It is leading bank in Ghana, offers retail, corporate, and investment services. The GCB is one of the leading banks in Ghana, providing retail and corporate and investment banking services to all its customers. That is strong liquidity and capital, careful lending policies, and credit risk management. So the GCB focuses on maintaining strong liquidity and capital, applying careful lending practices, and managing credit risk effectively. That is the strategy of the GCB to meet these shocks. So the diversification, multiple financial products, reduce reliance on loans, improved revenue streams. The bank offers a wide range of financial products to reduce dependence on loans and create multiple revenue streams. Digital transformation. Mobile and online banking improves efficiency, enhances customer experience. GTB uses mobile and online banking platforms to improve efficiency and enhance customer experience. And you have risk management. You have compliance with Bank of Ghana, strong financial control, and stability during uncertainty. The bank complies with Bank of Ghana regulations and maintains strong internal controls to ensure stability during economic uncertainty. In conclusion, inflation and interest rate shocks significantly impact banks. However, GCB adapts through strategic planning, digital innovation, and effective risk management to make sure that they are not really affected by these shocks. So, thank you.